last decade, if you have invested 10,000 in the US S&P 500, you would have seen strong returns. But here is the twist. If you compare that to the most other markets around the world, the US has completely dominated. And today, the gap between US stocks and international markets is one of the widest we have ever seen. Hi, I am Ricky Jussel, the peaceful investor, and on this channel, I focus on long-term investing, avoiding hype and finding real opportunities that have less downside and huge upside potential. And while US stocks are trading at some of the highest valuation in history, many international indexes are trading at half of the price. Some at levels we haven't seen in decades. And that's why the smart money is quietly moving out of US and into undervalued global markets. In this video, I am going to share my top 5 global index picks for the next 5 to 10 years. These aren't hype plays, they are undervalued markets with real growth potential, unique catalyst, and in many cases, strong institutional inflows. We will cover developed markets like Japan and Europe, emerging opportunities in Mexico and Brazil, and even a deep value contrarian bet in China. Each comes with its own risk, but also huge long-term potential. So if you want to know where the next decade's growth could come from outside the US, this is the video for you. So let's dive in. Japan is my number one pick. After decades of stagnation, the story is changing. Corporate governance reforms and shareholder-friendly practices like buybacks and higher dividends are finally taking root. On the top of that, the weak yen has been a massive tailwind for exporters, keeping Japanese companies competitive globally. Valuations: trailing PE 16 times, forward PE 21 times, and dividend yield 2%. Even though the forward PE has ticked higher due to strong price gains, valuations are still more reasonable than US, where CAPE and forward multiples remain elevated. Risks: demographics. Japan has one of the oldest populations in the world, which limits long-term domestic consumption. Currency volatility: if the Bank of Japan shifts its policies and the yen strengthens sharply, exporters could see pressure. As an investor, you can invest in the Japan index through US listed ETFs. These are available in USD and track Japan's broad equity markets, giving you exposure to the country without dealing directly in yen. A few options are available. EWJ iShares MSCI Japan ETF from BlackRock, the most widely traded Japan ETF covering large and mid-cap companies. DXJ Wisdom Tree Japan Hedged Equity Fund from Wisdom Tree offers exposure to Japanese equities but hedges the yen, protecting you from currency swings. JPXN iShares JPX Nikkei 400 ETF from BlackRock tracks 400 high-quality Japanese corporates with better governance and profitability. Mexico is my number 2 pick. The country is uniquely positioned to benefit from nourishing boom as US companies shift supply chains closer to home. Combined with a young population and a resilient peso, Mexico offers one of the strongest emerging market growth stories today. Valuations: trailing PE 12 times, forward PE 12 times, price to book 2 times, GDP growth outlook 2.5%. These valuations look reasonable compared to US, especially with stronger demographic and structural tailwinds. Risks: political unpredictability and populist policies. Security concerns that can deter foreign investment. Heavy reliance on US economy for trade and remittances. ETFs available for US investors. You can invest in the Mexico index through US listed ETFs. These funds are available in USD and track the Mexican equity market, giving you direct exposure without currency hassle. One of the most widely used is EWW, iShare MCI Mexico ETF from BlackRock, provides exposure to large and mid-cap Mexican companies across multiple sectors. Europe takes the third spot. Both UK and broader European stocks are among the cheapest developed market today. Investors are also returning, with institutional flows moving into European equities for the first time in years. Valuations: trailing PE 16 times, forward 14 times, UK forward PE 12 times, and dividend yield 3 to 4%. Compared to US, Europe looks attractively priced, especially given the strong income from dividends. Risks: low long-term GDP growth, typically around 1%, political fragmentation across EU and potential trade frictions with the UK, heavy exposure to cyclical sectors like energy and financials. As an investor, you can invest in Europe through US listed ETFs. These funds are available in USD and track both the UK and the broader European markets. Here are a few options. VGK, Vanguard FTSE Europe ETF from Vanguard, broad European exposure with large and mid-cap stocks. Next, IEUR, iShares MSCI Europe ETF from BlackRock, covers developed European markets including the Eurozone and the UK. Next is EWU, iShare MSCI United Kingdom ETF from BlackRock, provides direct exposure to UK equities, heavily weighted in energy, financials, and staples. Brazil is my fourth pick. It's a classic deep value plus commodities story, one of the cheapest large markets globally, with leverage to oil, iron ore, agriculture, and a recovering domestic cycle. Valuations: trailing PE 10 times and the forward PE 8.6 times, dividend yield 3 to 4%. At these multiples, a lot of risk is already priced in. Any improvement in growth or a supportive commodity cycle can drive strong upside. Risks: currency volatility. Swings can amplify gains, losses in USD terms. Policy and politics. Reform momentum can stall around election cycles. Commodity dependence. Global slowdowns or China weakness can hit exports and earnings. So you can invest in Brazil index through US listed ETFs. These funds are available in USD and track Brazil equity market, giving you broad exposure without dealing directly in BRL. A few options are available. EWZ, iShare MSCI Brazil ETF from BlackRock, flagship Brazil ETF covering large mid-cap across sectors. EWZS, iShare MSCI Brazil Small Cap ETF from BlackRock, tilts to smaller, more domestically focused companies. China through Hong Kong is my fifth pick. Sentiment toward Chinese equities is at rock bottom, but that's exactly what makes it interesting. The valuations are among the lowest in the world, and even a modest improvement in policy or sentiment could unlock significant upside. So its trailing PE is 14 times and the forward is 12 times. The price to book 1 time and the dividend yield 3%, with a cap in the single digits to low teens. China looks deeply undervalued compared to US or Europe. Risks: regulations, crackdown in tech and property weight on sentiment. Geopoliticals: US China tensions remain a constant risk. Structural slowdown, aging demographics, and debt overhang in property and local governments. Despite these risks, valuations already reflect extreme pessimism, leaving room for rebound. As an investor, you can invest in the China index through US listed ETFs. These are available in USD and track Chinese and Hong Kong equities, giving you exposure without direct currency complications. And a few options are available. FXI, iShare China Large Cap ETF from BlackRock, focuses on the largest Chinese companies, many Hong Kong listed. MCHI, iShare MCSI China ETF from BlackRock, broader exposure to large and mid-cap Chinese equities. EWH, iShare MCSI Hong Kong ETF from BlackRock, exposure to Hong Kong blue chip stocks. KWEB, Crane Shares CSI China Internet ETF, tech and internet sector focus, higher risk but higher potential reward. So those are my top 5 global index picks for the next 5 to 10 years: Japan, Mexico, Europe, Brazil, and China, Hong Kong. Each one comes with its own risks, but all are trading at much cheaper valuations compared to US market. That gives them a better risk reward profile and the potential to outperform as global capital rotates away from expensive US stocks. As investors, we can diversify globally using ETFs that are listed in the US and available in USD. This means you don't have to worry about local exchanges or currency conversions. You can get exposure directly through your brokerage account. My philosophy is simple: I avoid hype, I look for value, and I invest for the long term. These 5 regions are, in my view, some of the best opportunities to position for the next decade. Now, I would love to hear from you. Which of these markets do you think has the best upside over the next decade? Comment below and let me know your thoughts. And if you found this helpful, don't forget to hit the like button and subscribe. I post deep dive investing content to help you build wealth with patience, discipline, and peace of mind. Thank you.